All right, well, hello everybody. This is the class video that was intended to be uh, sort of run live on the 13th, which was Thursday. We had some problems in the middle of recording, and I'm not quite sure what happened. Everything just kind of went out. It was like the power sort of went out, and I don't know what happened. And subsequent attempts to sort of get this thing to record apparently weren't very good because I was missing there were some gaps I was missing. So anyway, I don't believe these are the same issues at all that we had earlier with. We just had a really old computer in the room that we were in previously, so we haven't had those issues. And it could be operator error, it could be mine. I'm not infallible, but nonetheless, I do want to pick up from where we left off on Tuesday, the 11th, and continue talking about Chapter 11. So remember, in Chapter 11, we're still talking about long-term assets, and so we're sort of working our way down the left side of the balance sheet, asset side, in other words. And in Chapter 10, we talked about acquisitions of assets, of long-term assets, PP&E in particular, also intangibles. And we're going to talk about both property, plant, and equipment as well as intangibles. And but in this case, in the instance of Chapter 11, we're talking about the use of those assets and how we write the value of them down in terms of cost allocation, whether it's depreciation, depletion, or amortization. We're going to cover all of those topics here. And when we come back on Tuesday, this is which will be what will be that? Be the 18th, I guess. We'll have one more discussion in class live 10:30 on Tuesday about Chapter 11. It is a very dense chapter, which is one reason why I pushed the due dates back for the activities for this segment to the following week. And so you can look into Brightspace and see those dates have changed, and I've also changed them in Connect for the Chapter 11 activities. So there's really nothing to do this weekend. I've made that available. This weekend being the week beginning, I guess, well, beginning 11/10. So let's pick up from where we left off last time. I think this is sort of where we ended. At least according to my notes. We want to talk a bit about depreciation, and we're going to talk some more about it here in this video. And as we've done a number of times before, we oftentimes want to compare and contrast accounting methods and techniques and how they may differ between GAAP accounting, which is primarily US-based GAAP, which is why we sometimes call it US GAAP, and the international standards, the International Financial Reporting Standards. And so let's talk just a bit about depreciation. And by the way, there are a number of differences that come up again and again. And for those of you who are really truly interested in international accounting, you can probably, go on to take an international accounting course, which is going to focus strictly on the IFRS standards. We can only sort of scratch the surface. But I will tell you, though, that in Chapter 11 is probably, at least in my experience, probably some of the most meaningful differences make themselves manifest. A lot of it had to do with fair value accounting, and so we'll talk a bit about that. But let's talk about depreciation here. So within depreciation of GAAP, it's component depreciation is allowed, but is not often used in practice. We talked a bit about this is where we sort of left off on Tuesday. We talked a bit about components where you've got different amounts, different things that are going on with the same property, and they have different depreciation bases. This is very similar to composite accounting, or composite depreciation, which we'll talk a bit more here in a second. In the international standards, each component must be depreciated separately unless its cost is significant in relation to the total cost of the item. And the question may arise here as to what is significant. And there are some tests which the IASB has laid out for that, which we're not really going to get into here, but nonetheless, we're just sort of pointing out that there is that difference. Also, on the GAAP side, depreciation basis is determined by subtracting estimated residual value. Same deal here, but the thing is, though, under the IFRS standards, and I've underlined this, a review of residual values at least annually is required. And by the way, the international standards really do require a review of long-term assets at least once a year, where for a lot of reasons. Number one, does the estimated useful life make sense? Which means, does the depreciation expense make sense? Are we so as not to mislead users? Also, another issue really concerns impairment, and the tests for impairment are a little bit different. They're similar, but they're a little bit different between GAAP and IFRS standards. And so, but that's an issue as well, where the IASB is pretty firm on companies reviewing those long-term assets for those issues as well as others. And on depreciation methods, various methods we use. We've talked about them: straight line, declining balance, units of production method. Those are some of the big ones here. And here we mentioned three depreciation methods: straight line, units of production, something called the diminishing balance method, which is similar but not quite the same. And again, if you want more details on that, you are free to explore that, but it's not really a key topic of what we're trying to do here. So that's kind of a roundup. I think I may have covered this actually before, but probably bears repeating. So let's talk a bit about some additional issues here. And one of the big ones, and it's kind of comes up again and again. And I know that maybe we oversimplify acquisition dates and disposition dates in accounting textbooks pretty generally, where we say, hey, we want a truck on January the 1st and we sold it on December 31st, and meaning that we're doing business on January the 1st and New Year's Day and New Year's Eve both, really? In reality, obviously, as we all know, these transactions happen throughout the year, and so we need to find a way to match the depreciation expense with the usage of those assets, because if the asset's placed in service, then we should be, and it's a depreciable asset, then we should be allocating its cost over time through depreciation expense. But also depletion and amortization also are similar. Depletion and amortization is more of a straight line issue. Depletion, we're going to talk about here in a second, but nonetheless, the fractional year accounting, particularly the first year and last year, are necessary. And it's interesting, the text talks about the half-year convention. This is more for tax purposes, really, under the MAKERS system. MAKERS is an acronym standing for Modified Accelerated Cost Recovery System. If you have never taken tax before, I wouldn't really worry about that very much. But it's a declining balance method. And I think I mentioned that before. The double declining balance method is what's used primarily for depreciable assets, not including real estate, which is straight line, but for depreciable assets under the U.S. tax code. And the half-year convention is basically saying, whenever you bought it, we're going to assume you bought it on July 1st, right? And there are some exceptions to that. If you sort of backload all your purchases between Christmas and New Year's, there's a sort of a sanction placed on companies that try to do that. But for the most part, the half-year convention is simply a tax measure that says, okay, we don't really care when you bought it for tax purposes. And the differences over time are probably not going to be extreme. As we're going to see in a minute, all methods of depreciation are going to lead the same direction. So, okay, so we're back to our Hogan Manufacturing. We've talked about these guys before, where they bought a machine for $250,000, but now they bought it on April 1st. So this is 3 months into the year. So we have 3/4 of the year remaining. That is 9 months. And they had the following estimates. By the way, there's an error. It says 140. It should be 150 based upon these. And so I think what happens is there are some errors occasionally in these slides. The texts get reviewed over time, and I think sometimes the textbook publishers, which I didn't create this, the textbook publisher did, I think they sometimes they're not as vigilant updating some of these. So as I looked at this, I thought, wait a minute, these numbers don't add up. And so it is 150,000 units. And they have a 12/31 year end. So actual production was this. And this slide is a little bit out of place. All this is really telling us is at the end of the depreciation period, 5 years, all roads lead to the same figure. That's 210,000. And that's the amount of depreciation that's going to be taken. But the ways to get there are different. So let's take a look at straight line. But now what's different about straight line is that before we just simply said, okay, we bought a piece of machinery on January the 1st, and the first year's depreciation is going to be, well, whatever if it's straight line, it's cost minus residual or salvage, whichever you prefer, divided by the estimated useful life in years. And so if it's 5 years, it's going to be, basically 20% of that depreciable base. The base being cost minus residual. Okay. But in this case, we only had 3/4 of a year. And so for straight line purposes, we're going to take 3/4 of what would be the annual depreciation. Okay. For declining balance, the same issue, except on declining balance, we don't take out for residual. So, and that's also consistent with how we do it in tax, which again is a double declining method under MAKERS for everything but real estate for the most part. But now it's not 20%, it's 40%, so we're amping it up. But same 3/4 of a year, 75,000. And the units of production method simply taking the depreciable basis, no, I'm sorry, depreciable base, well, which we really call basis actually, divided by by the expected number of units, and then whatever the actual number of units that are produced during that time period is the amount that we apply to depreciation. And again, there are some assets that sort of lend themselves well to units of production, things like maybe aircraft and certainly trucks. I've worked with a lot of clients who've been in trucking companies who use units of production because they feel it better matches expenses and revenues and produces a little better results. And so I can't argue with that too much. And so that's what's going on there under straight line. The rest of the time, the next 4 years, it's going to be the same 42,000. And then we're going to pick up the other 1/4 of the year that we skipped. Not why we skip it, we're just simply picking up 3 months into 2026. And so when we talk about buying an asset, putting an asset in service in the middle of a year, even if it's a 5-year life, 10-year life, whatever, we're going to span more than those 5 years or 10 years or whatever, because we're picking up a partial year and we're picking up on the end. Straight line makes it very easy. There's nothing really difficult about this. Accountants will also, and one question that comes up that accountants will often say is, if the asset's bought before the 15th of the month or 1st of the 15th, it's going to go on that month's record as having purchased it. If it's after that, even if it's 28 days in the month, it doesn't make any difference. It'll go on the next month. These differences are not particularly material over time, but that's just sort of a rule of thumb because, I mean, are you really going to go buy an asset on the 1st of every month? You're going to buy it whenever you need to buy it. So, or acquire it however you need to acquire it and whenever. Okay. And so for the double declining, then it's the same percentage. But in this case, so we start with the original acquisition price, 250. We're going to subtract 75,000. So we have a new depreciable basis of 175 times 40, which brings it down 70,000 for that year. We take that 70 away for the next year, on and on and on. But notice here that we're going to depreciate this faster, which is the whole point of double declining balance. And outside of the tax realm, I think I may have mentioned this before, but sometimes the rationale is, hey, this asset is going to be far more productive in the early years than the later years. It's going to require more maintenance. It's not going to be as efficient, whatever. And so it may make sense to do the accelerated method. And so, and again, there's no conflict between straight line and tax purposes, unlike, as your text even mentioned, the LIFO conformity rule. It's like you use one or the other, LIFO, FIFO, or whatever. But if you use LIFO for tax, which you would do for tax purposes, you also have to use the same for financial reporting. That particular rule does not apply here. In fact, companies use different methods for different sorts of purposes, and so they'll do whatever makes the most sense. So, okay, and there's some flexibility. The final units of production method is going to bring us down to 210,000. So that's cost minus salvage or residual. So the idea is we're going to get to the same place theoretically, but we're going to get there at different times. In the case of double declining balance, and we're going to get there with different expenses. And it's not an insignificant issue, I guess, particularly in the early years. Declining balance really reduces net income. And so a lot of companies don't like it for that purpose if they're trying to show users, hey, we're making money consistently. Obviously publicly traded companies, their work is often analyzed by pretty professional analysts. I can't say the same is always the case for bankers who may not be completely aware of what's going on with the difference between straight line and double declining balance. Having been a banker, I can tell you, I would hope that's the case. I don't know that always is the case. So companies often want to sort of pump up those numbers. And so, and that's something to consider there. Straight line is far and away the most used for obvious reasons. The simplicity, it also evens out the expense over time. So there's a lot of good reasons to use it. Okay, quick question here. Machines purchased on September 30th of 2021 for 30,000. Useful life is estimated at 4 years. No residuals anticipated. They're using double declining balance, and the acquiring company's fiscal year ends on December 31st. So depreciation for 2022 should be. Okay, well, there are a couple of things going on here. Number one, we have a partial year going on. Okay, we also have double declining balance, and the estimated life is 4 years, which under straight line, remember, double declining is twice the straight line rate. So a 4-year depreciation would be 25% a year, which we're now going to take up to 50% a year. And we also have an intermediate term here. So it's going to be 3 months or 1/4 of the year in 2021. So we have to calculate that first. Okay, that's what we have to do. And then we have to pick up the rest of that year and roll that over into the next year. Let's do that. So this is a little bit tricky. So make sure that you're really following what these steps are. So because remember, you don't just say, okay, you bought it in September, but now that year is done. So we're going to take a full year's depreciation based on the same dollar figure, only simply, on a per month basis, the same thing. That's not what's going on here. So in 2021, we have 30,000. That was the acquisition price. Remember, we're not taking out residual times 50%. That's the rate. In only 3 months, so 3,750 is recorded in the first year. In the second year, we're going to pick up the rest of those 9 months. Okay. Remember, double declining balance, because that's why I said there are a couple things going on. You have a fractional year, which is not unusual at all, but also the full year is not over yet. And remember, every year is going to be different because you're depreciating this faster than you would under straight line. And so you're taking 30,000 times 50% times the 9/12, okay, which is 11,250. So for that first year, the first 12 months, it's going to be 3,750 plus 11,250 is 15,000, which for 2022, the rest of 2022, you're going to take away from the original cost, right? Because we change the depreciable base every time we record a year's depreciation, times 50% times the last 3 months of 2022, as you're going to 1875. Adding this together here, we end up with now this is the question is how much are we going to record in 2022, and it's going to be the answer is going to be B, 13,125, because it's going to be this and this 11,250 plus 1875. I got a little bit confused here because I thought, what is it? Looks like we're adding all these. We're not. This is 2022 depreciation, just this and that. So 13,125. Okay. And then as we go forward, every year going forward, we're still going to remember these acquisition dates, which were September 30th, every September 30th going forward until this asset is depreciated. And again, I know we've said this a gazillion times, but software will do this and it'll do it very accurately. In fact, it's an adjusting entry, but it's an adjusting entry that the software does very accurately. So that's not really a problem in real life. It looks like this is going to be onerous for every long-term asset, but it's not really so much. The adjusting entries will be handled pretty accurately, unless there's some change that needs to happen in terms of restatement of useful life or whatever. If that's the case, then we have a way to deal with that. But for the most part, that's what's happening. So that's the entry for 2022 is going to be 13,125. Okay. All right, let's talk a bit about dispositions. And when we say disposition, I think we usually think of sale or selling the asset. It's not always the case. It's however the asset leaves the books. However, this asset becomes no longer an asset because it's either sold, it's destroyed, it's stolen, it's obsolete, it's no longer operable, it's worn out, and then we have to decide what to do with that. And first of all, we have to decide operationally what we're doing with it. But then, what is the accounting treatment? And it's not particularly complicated. Any kind of gain or loss is going to be recognized between anything that is received for it, if anything, and whatever the book value of that asset is. Sometimes there is no consideration. Sometimes it's simply a case in which, this asset is trash, haul it away to wherever you haul it away, and that's it. So, there is no consideration. But if there is, we take that consideration minus the book value, and we either have a gain or a loss. Obviously, we have no figures here. But keep in mind, too, that if the asset is depreciable, and we've been depreciating that asset over time, we have to take not only the cost off the books, but also the accumulated depreciation, the contra asset that attaches to the asset itself. That's what makes book value, or what we call net book value. And so as a result, we have a gain or a loss. Okay. Now we'll talk a bit more about what it means to have a gain or a loss from an accounting perspective here, and we'll talk a bit about that. So in this case, we have back to our folks at Hogan Manufacturing on January the 1st, they bought a machine. So we're back to the January the 1st purchase date for $250,000. The company expects the service life to be 5 years, and the residual is $240. So that's going to be obviously taken out here. If you can see my cursor, 250 minus 40 over 5 years is going to be annual depreciation of $42,000. But 3 years in, that is the end of the 2023, decides that it wants to sell the asset for $140,000. So first thing we have to do is update the depreciation of the date of sale. In other words, we have to make an adjusting entry. So this is not unusual. So this is in a case in which we would definitely do a manual adjusting entry to say, okay, let's bring it current. So we have to update the book value. The net book value is going to be cost minus accumulated depreciation. And so it's the end of the year, so that makes it pretty easy anyway. So you have 3 years, 42, 42, 42 is 126. And so 250 minus 126 would be 124 as a book value. So it looks like we're going to have a gain, right? There's going to be a book gain from the sale of that asset. Okay, so we would record that sort of down toward the bottom of the income statement because it's not really an operating item. And so what do we have here? So here are the facts. We have 140 as the sales price. The net book value is the cost minus accumulated depreciation. So 124 is less than 140. So we have a gain of 160, or that's 16,000. And the journal entry is simply this: we sold the thing for 140,000. That's cash. We take off the asset. So the asset is a debit balance that we zero out by crediting that asset, and the accumulated depreciation is a contrast. It's a credit that we zero out by debiting it. So that goes away. And so to make the thing balance, we have 16,000 as a credit balance, and it increases net income in that period. Doesn't increase operating income because presumably the company's not in the business of selling its long-term production assets or operational assets, whatever you want to call them, operating assets, I guess. So we do record a gain, okay? And that's a pretty simple event. We would do the same thing if we had a loss. If it was a small fee, if it was 120,000, well, we would have a loss of 4,000. So you kind of get the idea. And then everything would be, and the only thing we'd have a debit balance over here in order to balance that out. So, okay. All right. Now let's talk a bit about what this really means, because I think it's important. I like the way the authors had sort of broken this out and specify what's happening here. And so when we talk about a gain, simply saying that we sold the asset for more than its book value. And again, I know I'm a broken record when I keep talking about the differences between book value and fair market value. Fair market value is what this asset might be worth in an exchange among unrelated parties, and what's called an arm's length transaction. Okay, so that's one thing. Book value is not exactly arbitrary, but I mean it's going to differ depending on what depreciation method you use. And so and so all we're really simply saying is we have to figure out a way to reconcile the accounting records with this. And so it's not really an economic gain necessarily. It could be. We're not saying it is never, but it's not necessarily an economic gain. Okay, it's just simply, I mean, if we're using double declining balance and we've accelerated depreciation on it, then there's a pretty good chance we're more likely to have a gain than we are a loss. And so that doesn't mean that we're overly clever or whatnot. It just simply means this is the difference between the selling price and which is the fair market value presumably, and the book value. And so that's what it means. And so the same goes here with the loss. It's less than the book value of the asset being sold. And again, there's a net decrease in the book value of the total assets. All we're doing is we're simply removing this asset from the balance sheet and recording a gain or a loss, depending upon what the exchange value was or the sales price. Okay. All right. So let's see here. And again, I know that some of this, if you were here in class, physically in class on Thursday or on the live Zoom feed, some of this is repetitious, and I apologize for that. So. But I do think it was important for us to sort of cover some of this once again. So, okay. All right, let's talk. So we have a full class session. So let's talk a bit about assets held for sale. When we talk about assets being held for sale, this is going to become more of a thing when we get into marketable securities. But for the most part, if management meets all these, if the asset in question meets all these criteria, then we would say it's classified for sale. And the reporting of that is how we want to report this on the balance sheet, because this asset is going to be leaving the books soon, and we want to be able to report to users what the facts are regarding that asset that's marked for sale. So management has to have some kind of plan to sell the asset, whether it's a plant somewhere, a building, a piece of land, equipment, whatever the case may be. It could be a whole division or a subsidiary. There's got to be some kind of plan. It's going to be available for immediate sale, It's present conditions, so these are not impaired assets. These are things that are ready to go. So, and things people would presumably want. Somebody on the demand side would want. There's got to be a plan to locate a buyer, and the sales it's been initiated, and that we would expect it to happen within a year. Okay, so this is leading up to a reporting period. All this is giving guidance as to how we report the value of the asset, and it's being offered for sale at a reasonable price relative to its fair value. Okay, so it's not some fire sale. It's a reasonably priced asset because we're going to sort of mark this at a conservative value. Management's actions also indicate the plan is unlikely to change or be withdrawn. It doesn't mean it can't be withdrawn, but at least going into it under the principle of fair representation, we want to make sure that this is the initial plan. And so how we report this is either the lower of the current book value or the fair value minus any transaction costs, any cost to sell. If there are realtors involved, attorneys involved, shipping, whatever the case might be, all that would be deducted from that particular fair value. And so the comparison of that with the book value is what's reported, and it's the lower of that. It's similar to the concept of lower of cost or net realizable value, which I know is a current assets concept, really applying to inventory primarily, but it's essentially the same idea. But what it really represents is something that in the accounting profession is known as the conservatism principle, where we don't want to mislead users by giving them too much information or give them or maybe present an overly rosy view of what's happening. So we're going to take the lower of that. So, okay. And that's the plan. Again, facts could change and things may not go the way the original plan called for, but nonetheless, that's the goal going into it. Okay. All right. And then when we talk about retirements, an asset that's being retired is simply one we're taking it off the books. Typically, there's a loss. It's usually with whatever the remaining book value is recorded. A lot of times, when I think of retired assets, and it's not always the case that retired assets have to be fully depreciated, but I think we're usually talking about fully depreciated assets, meaning that we bought a machine for $100,000 and had $10,000 residual. And at the end of the time, it's still being carried in the books years after that asset has been depreciated off the books. And by the way, this is not all that uncommon, really. It's oftentimes the case that we have assets that we hold on to long after the estimated useful life is over. Think furniture, for instance. I mean, furniture can last for quite a long time, so maybe not things like computers and whatnot, but, certainly things like furniture, fixtures, a lot of equipment, conveyor belts. I mean, a lot of assets, live on well past their useful life. And the useful life is simply, a good faith estimate going into it. So, and one particular example that comes to mind is in the machine tool industry. And I had a number of clients who were machine tool companies that make, parts. If a big manufacturer needs a part, they can't go to, Home Depot and get it. They've got to have it made. And so there are a lot of companies that do that. And so, and some of those machines have been around literally for decades. And we financed a lot of them. These were 40-year-old pieces of equipment, and they were still just as almost. And some will say they're better now than they were when they were new. I've heard that more than once. I don't know if that's true, if that's a bit of a myth. But nonetheless, my point is that some of these assets can go on and on for a very long time. And so when the asset finally is retired, whatever that remaining residual value is at the beginning, unless it's changed for whatever reason, is going to be just simply written off, and the loss is going to be equivalent to whatever that is on the books. It could be that they change the residual value down the road. That's something that is not unheard of, but you get the idea. These assets often are depreciated off the books and down to a very, very low dollar figure. And it doesn't have to be assets that are fully, quote unquote, fully depreciated, but it might be. So, okay. And we're thinking primarily of whatever depreciation method would involve a residual value, because obviously some methods do not involve the residual, like declining balance, where the assumption is zero. And even under some straight line conditions, a lot of companies will say it's going to be zero. So, and so you get the idea. And so if there is a book value, it's often a loss that's going to be taken. So, okay. All right, so I want to talk a little bit about group and composite depreciation methods. Composite depreciation, I Some intermediate textbooks get into this a lot more detail. We don't really so much here. We do get into the group method a little bit more than the composite method, and we'll talk about why the group method is used and what the advantages are of it, and maybe some of the drawbacks. I guess I have to. I'll just tell you what I think from a practical standpoint are some of the challenges with it. But we talk about both of these methods. They're not quite the same, actually. In fact, I would have kind of prefer they sort of separate these out because it makes it sound like they're the same thing, only different flavor. Not really. When we're talking about the group method, we're talking about assets that are essentially the same. Maybe they've got different acquisition dates, estimated useful lives, different residuals and whatnot, but they're all likely the same. So things like all taxis, vehicles sort of meet this characteristic. They are purchased at different dates and whatnot. So you might use the group method, and it might actually approximate taking every individual single asset. Oh, it's done for simplicity purposes. I think in some ways it may be a little outdated, really, particularly since you can list every single asset the company has, including every long-term asset that goes into PPA, and you can simply depreciate without that much effort. But nonetheless, it still is accepted and is useful, particularly when these assets are very similar. When we talk about composite depreciation, I think I may have mentioned this before. Some examples of this are these are assets in which you've got really different kinds of components that have different depreciable bases and particularly estimated useful lives. One good example of a composite depreciation method was applied to something like a telephone pole. You've got a big piece of wood that's got decades long life. Then you've got electronic components that don't have quite that long life. But are you going to depreciate all those items individually? Well, under the international standards, you might. With the composite method, you'll simply say, okay, we're going to weight these according to their relative contribution to the total asset itself. Then how many of these telephone poles or cell phone towers or whatever that have these different components. And a lot of times they're just because some of these are we know are going to wear out more quickly, then we're going to apply that method. So it's a little bit different. These are not similar assets that are grouped together. So, okay. And again, we don't get into that much really in terms of the composite method, but we did want to talk about the group method. So in this case, we've got a company that's got delivery vehicles. And again, vehicles are sort of tailor-made for this as an example. The express delivery company began operations in 2021. It's going to depreciate its fleet of vehicles. It's going to use the group method, okay? And the vehicles purchased early in 2021, along with their residual values, estimated useful lives, and straight line depreciation per year by type of vehicle are as follows. As you've got vans, trucks, and wagons. When we say group, what we're talking about is we're grouping these together by similar characteristics. In this case, we've got three different classes or three different groups: vans, trucks, and wagons. And so we take these collectively at 150,000 minus residuals, depreciable base 120, 6-year estimated useful life 20,000 a year. Same goes to trucks. Cost minus residuals 104 divided by 5 is 20,000. Over time, is that right? Yeah, 20,000. No, 20,800. Yeah, I didn't think that was right. 20,800, and then wagons 60 minus 12 is 48 divided by 4 is 12. So 52,800 is the amount that's going to be taken for the whole full year. And again, we're starting it early in 2021, presumably early enough that we could take that full year first year depreciation. So if you take this divided by that, okay, you're going to get a depreciation rate of 16%. That's going to be the rate you're going to apply to all these assets that are going to apply in this area. And so if we take a look at the depreciable base of 272 divided by 52.8, we're going to end up with an average service life of 5.15 years. Now, notice what's happening here is we're going to be depreciating these assets longer, and while these, for that matter, longer than their estimated useful life. So for simplicity purposes, we're actually taking some of this in this group, this collective group, a little bit longer than what we would have otherwise. And so, but this makes for simplicity. We're simply taking 16% times the original cost minus salvage all the way down until we reach the residual value, and then we're done. And again, I kind of go in and out between using the term salvage value and residual value. They're sort of the same thing. I think I sort of it was always savage when I was coming up, and so but I think a lot of people don't like the term salvage because it sort of implies that any depreciated asset is sort of junk and it's ready to go off the junkyard. That's not really what is the case. So, okay. All right. So we talk about this. Here are some of the complications beyond so their simplicity is a benefit, but some of the drawbacks are potentially the fact that these assets in this group are going to buy new assets. We're going to dispose of assets. And every time we add assets, we're going to simply change this whole calculation every time we do it. But we're still going to use the same depreciation rate over time. And the big thing is, as we get to the end of the period and we start to dispose of these, we don't record a gain or a loss. We simply adjust the book value, and we just simply credit the asset, and it's gone. We don't record a gain or a loss either one. And so I don't know how accurate that is in reality, but it is a method that's used. And so in this case, here's the gain or loss. It's basically absorbed in the vehicle itself. So we receive 3,000 cash for this vehicle. We have this much accumulated depreciation. And so we're not going to adjust the book value. We're simply going to take the vehicle. We're going to mark it off and take it off the books. And so an example here, El Paso Natural Gas, I'm assuming this is a real company. And it says when we retire PP&E, we charge accumulated depreciation and amortization for the cost, in addition to the cost to remove, which we've talked about, less their salvage value or residual. We do not recognize a gain or loss unless we sell an entire operating unit. So again, we're not recording a gain or loss. And so it's a little bit of a simpler way of doing it. It makes life a little bit simpler, but given what some of the issues are with that. So, okay, so when we do some comparison between GAAP and IFRS standards, we value property on the books, PP&E in this case, at cost minus accumulated depreciation. That's what gives us our book value. And GAAP does not allow revaluation. In other words, a step up in value. This is something that's prohibited. There are some exceptions with some assets that are more liquid, but we're not going to get into that here because we're talking about long-term assets. This is, in my mind, this is one of the significant differences, not the only difference certainly, but it's a pretty significant difference between the GAAP standards and the international standards. Under the IFRS, allows a company to report PP&E at the book value or at its fair value, so revaluations are necessary. But if it's chosen, we have to review it on a regular basis. And so again, the IASB is pretty firm on this notion of companies evaluating their long-term assets, at least on an annual basis, and just making sure that they, first of all, are not impaired. But then, are they being? Is the book value reflective of what is actually going on? So in some ways, you can think that fair value may make a little bit more sense. It may actually inform users a little bit more than book value, particularly book value minus accumulated depreciation is very small in relation to the fair value. And one area that comes to mind is real estate, where we buy a building for $20 million and we depreciate it down to, I don't know, 500,000. But the property goes up in value over time. It's worth $100 million. It's worth 5 times as much. And so are we, and I know the conservatism principle sort of applies here. We're not over, and some will say, well, who's to say what fair value is? Well, that's a good point. But still, the difference between 500,000 and 100 million is pretty significant. So, are we misleading it by being overly pessimistic? And so you kind of get the idea there. One factor that might weigh in for not revaluing is the fact that we don't pump up shareholders' equity, and so we have a lower shareholders' equity. We have a higher return on equity, and that's ROE, which is simply net income over shareholders' equity. Sometimes we take out preferred dividends, whatever, in the numerator, but it's basically net income over shareholders' equity. If you've got a lower shareholders' equity, you're going to have a higher ROE. That's a percentage, and so that would argue in favor of the historical cost method without revaluation. So that's among the other issues why GAAP does not allow for revaluation. But again, as I've said before, that the proponents of not revaluing long-term assets at fair market value are pretty vocal, and they've made their case pretty clearly. So okay. All right, and then let's get to depletion. So we've talked about depreciation. We're going to talk about depletion, and we're going to talk about amortization, and we'll probably stop somewhere around the end of this dealing with amortization. But let's talk about depletion. Depletion is simply a cost allocation method which is not so much time-based as it is activity-based, where it's usually, well, I can't, when I say usually, it's going to be primarily dealing with natural resources, often minerals, but also timber, perhaps, and depletion is simply the using up of the value of that asset over time in order to bring the value of that asset down to something to allocate that cost over time until we get to the point where there's nothing really left to mine or to harvest or whatever. So that's what's going on there. It's basically units of production method. It's activity based as opposed to time based. Remember, we talked about cost allocation of PP&E as being either time based or units or activity based. And so this is going to be activity based, even for the long-term assets like vehicles and whatnot that could be have other uses. They're still going to be under this could fall under this depletion method. We'll get to that in a second. And it's going to vary depending upon how much is being extracted. So the base, which is the numerator of the calculation, is going to be the cost minus residual. This is not anything different than under straight line, for instance. And then we have, but the numerator, I'm sorry, the denominator is going to be the estimated units. And so however many units we have, we divide in, or how many units we extract, we divide into that base on an annual basis, and that's what we use to record a depletion expense. Okay, and so the journal entry is simply depletion, which is expense, debit balance, and the asset we credit, and because we're bringing down that value itself, and so we're going to do that. So here's an example. 2021 Jackson Mining has the following costs related to 500 acres of land in Pennsylvania. They're going to be mining coal. Okay. So a lot of times when you're talking about just acres of land and not like coal mines, like in the mountains, you're talking about strip mining, where I saw this a lot when I was a kid because my grandfather was in that business. They would just go back and forth, all the way digging down into the ground in order to extract coal. And at the end of it, they oftentimes were on the hook contractually to restore that land back to its original use. And believe it or not, I know the coal industry gets a really bad name. So he's not here to sort of hear the criticism today, but believe it or not, they do restore it. You know, put the dirt back in, fill it back up. Sometimes put a little lake in there. Plant trees. It's actually, you know, when they do it right, it's actually pretty good. So in fact, you can start to grow crops on it if you want, whatever use you want to have of it. So anyway, but the acquisition costs, which we're going to be capitalizing here, that's going to be formed the depletion base, are going to be this: the right to explore. So exploration costs are important. Also, any kind of I'm sorry, these are the mineral rights, I should say. Exploration costs are good. These are the mineral rights that's being paid to someone. And what typically happens is the land upon which coal is extracted, or oil is drilled, or oil and natural gas oftentimes go together. That land is typically not owned by the company that's doing extracting. It's owned by someone else, even if it's the government. In the Western United States, a lot of the land is owned by the government, federal government by default. And so, and it's leased by companies. And so the mineral rights give that company the right to extract whatever minerals they're looking for. And so in this case, this is the right, and it's capitalized as an asset, which will be depleted through depletion expense. The actual exploration cost, the intangible development cost. In this case, if we're going to be digging a mine shaft, for instance, and we'll talk about what to do with this. These mine shafts typically are sort of sometimes left in place. That may be less common now than what it used to be back in the day, because it used to be that, you know, you have kids, you know, going into these old mine shafts because they were still there. And we're talking about, you know, the infrastructure that allowed miners to get back into that, you know, the rail and the light fixtures and all that stuff. And so, you know, so sometimes they're sort of left there. That might not be so as common now as what it used to be. And of course, the restoration cost altogether $2,760,360. And the company geologist estimates that 1 million tons is going to be the amount of extractable minerals in this case. So we take the cost, capitalized cost divided by this, you get $2.70.76836 per ton. So in this case, in the first year, we've got, 300,000 tons were mined. So 300,000 times that gives us depletion expense. It's a debit entry. This is the journal entry. And the coal mine itself is brought down by this amount. So it's not going to be straight lines, you know, unless they miraculously do the same amount of production every year, but it's going to be variable based upon how much is extracted. And at the end of the day, there may be more or less. And so there's a way to adjust for that. I don't think we really get into the termination, sort of the terminal expenses here. We're more interested not in the disposition, but simply in the allocation of cost over time. So, okay, so one example: Crystal Corp acquired a coal mine at a total cost of $15 million. The mine is expected to produce 30 million tons of coal over its 5-year useful life. During the first year, 3 million tons of coal were extracted. So depletion for the first year should be, well, this is pretty straightforward, really. I mean, $15 million is the cost. $30 million is the, I'm sorry, 30 million tons. So it's basically 50 cents a ton. And so it's gonna, half a dollar a ton times 3 million should be $1.5 million in the first year. So let's see if we agree on that, and we do. So that's that's a pretty straightforward example of how you would recognize depletion on that. Okay, and then if you have questions about depletion or really anything, you can feel free to contact me. We'll be more than glad to discuss with you. I mentioned at the sort of the beginning of this section on depletion that sometimes there are fixed assets that are what we call movable. That is, we can move them from one place to another, from one job to another. So we're talking about things like loaders and cranes and backhoes and all these kinds of things. They're not necessarily only for that particular job. They can be moved around. Now they may be dedicated to that job while it's happening, but it's movable. Now, and you might be thinking, well, what is not movable? Well, like a mine shaft is not movable. You're not going to be putting a mine shaft up on a truck and moving it anywhere. So that's something you wouldn't want to move. And also any restoration costs couldn't be movable. So, but things like vehicles in particular sort of come to mind. So here we just simply depreciate over its useful life or the life of the resource, whichever is shorter. And so the depletion base is going to be used here, and it's going to be on a per unit basis. And so extractable units are going to be the denominator. And so let's take a look at this particular example here, where we have a piece of equipment. I think it's a truck. Whatever it is, it's a. Let's see here. Does it say what it is? Doesn't really matter. So same facts as before, same cost here. $2,768,30. Oh, it's so 600,000 is the cost. It doesn't actually spell it out here, but it's simply saying 600,000 and 60,000 is the residual. So it's going to be 540 over a million tons. Remember, that was the depreciable base or the extractable estimate going into it at the beginning. So 54 cents per ton. That's 540,000 divided by a million tons is 54 cents per ton. And so in this case, we did 300,000 tons in that year. For this asset, okay, not the mine itself that we're depleting. We're taking depreciation, but we're attaching it to the base of depletion based upon that job. And again, that asset may outlive the job itself, in which case we simply keep on depreciating it. But as we're depreciating, if there's anything to depreciate, but we're still depreciating it as we go based upon the same level of activity. So it's the same numerator as in straight line, but it's the basis is the depreciable base that we're dividing it into in the denominator is, of course, different. So, okay. All right, so we talk about international versus GAAP standards. We need to talk about biological assets. This is one that I think a lot of people don't think about when we think about accounting for assets. And we're talking about things that are living, like timber, and things like crops and whatnot, but also animals and whatnot. We can, livestock and whatnot. We can accumulate, and in fact, we do depreciate livestock. We depreciate racehorses. We depreciate lots of these kinds of things, and so it is possible to. Maybe that sounds a little bit odd and whatever, but it is possible and it is done. So if you've got on the GAAP side, if you've got assets such as a timber tract or whatever, it's cost minus accumulated depreciation or depletion, whatever the case might be. Here on the national standards, fair value less the estimated cost is to sell. So it's a little bit different. The changes in fair value included in the calculation of net income. So any kind of change in those fair value estimates can alter net income. And again, the difference, it's a big difference between international and GAAP is the idea that international standards do allow for a change in value if the fair value does change. Okay, so that kind of does it for depletion. Let's move on to amortization, which I think is going to be sort of the last broad topic of this particular segment. And so we've talked a bit before about intangibles. Also, it was sort of covered at length in Principles 1, County 2110, if you took that here. Again, we're talking about things like patents, copyrights, trademarks, intellectual property of various kinds. And we'll also get into software, which is a little bit different. Software big business is a little bit unique, and it's really a gigantic business now. So we'll talk about that. But when we talk about the assets subject to amortization, which is the term of art used to allocate the cost over long time periods, we're talking about legal rights, essentially. That's really what's going on. You have a copyright, it's a legal right to use something. It's a trademark. Nobody can infringe upon your trademark. And if they do, then you can go after them, for damages. And so you have a claim against them. So this is why if you go to a restaurant or a Coke and they say they don't sell Coke, they'll always say, "Is Pepsi okay?" Because representing Pepsi as Coke is not good. Pepsi wouldn't like that. So they actually send people out to make sure that restaurants are not doing that, not making that mistake. So and if you think about it, I mean, there's not that much difference between Coke and Pepsi, really. I mean, maybe those are fighting words. I don't know with some people, but there's really not that much difference. By the way, Coke came out with New Coke because in their research, they found people couldn't tell the difference between Coke and Pepsi. What they did like was a little sweeter drink, and so they came out with New Coke. And of course, that was it's now a business school case study as to what not to do, messing with a brand and everything related to it. So including the name change, New Coke. So you're changing a brand. So, but anyway, you get the idea. There's a value to them, and we'll talk about how we allocate the cost if we do it all. If the life is indefinite, then we're not going to amortize it at all because we don't know what number to put on it, over what time period do we amortize it. So, but if it's got a definite life, like a patent, which is the most obvious example, a 20-year life, we're going to amortize that. And again, amortization is really sort of the catch-all concept for all these methods, including depreciation. Depreciation is a form of amortization. Depletion is a form of amortization. All amortization is simply reducing the value of something down over time to reflect the allocation of cost over long time periods. So that's really what it is. And we use the term amortization for a lot of things. Like if you get a mortgage loan, you might want to get an amortization schedule to find out how that particular obligation is going down in value over time. So it's used in a lot of different areas. So it's an estimated life. If there's a residual at all, and oftentimes there's not, but if there's a residual, we would include that. But typically it's going to be, or we would account for it. Typically it's going to be zero. And the method of amortization should reflect the pattern of use in generating benefits. I can tell you that I don't know that I've seen any accelerated amortization in my experience. I don't even know if I've come across it even in graduate school, even in master's or doctoral work. I don't know that I've ever seen it, but I suppose it's there. I do know that there are some companies that will have a contra asset for accumulated amortization, which is similar to the contra asset for depreciation, although you don't have to do that. Typically, you're just simply going to credit. It's going to be debit amortization expense, credit the asset itself, and that's the way you record the annual adjusting entry. So, example here, this is from Intel Corp, which we all know, and they've got in their notes, they've got different amounts of estimated useful lives for these different amounts of, or these different categories of intangibles, technology being an intangible. Intellectual property in general, IP is an intangible, and companies pay big money for it. So you can acquire it. So when you do that, you can have something that's going to be on the books for a long time. Things like customer relationships, I think we're getting into goodwill here. Acquisition-related brands, probably goodwill, but technology may have a limited life, and so that may be one that we would amortize over time. Technology does change rapidly, and so technology does not have an infinite life. And patents definitely do not have an infinite life, and so those would be amortized. So all these are again, they're legal rights, but they have value. If they didn't have value, nobody would pay for them, and so that's why we do it. So here's an example. We have Hollins Corp, and then this type's kind of small here, but Hollins Corp began operations in 2021. Early in January, the company bought the following two intangible assets: a franchise from this company for $200,000, and the franchise agreements for a period of 10 years. And so that math there is easy. a patent for $50,000. The remaining life of the patent is 13 years. However, due to expected obsolescence, the company estimates the useful life of the patent is only 8 years. Okay, let's take the franchise first. 200,000 divided by 10, easy peasy. Amortization, debit amortization expense, credit franchise. The franchise is an asset. To reduce the value of the franchise, we simply credit franchise on the balance sheet. That brings that down over time to the point where it'll be zero at some point. So because up to 10 years, that franchise will be worth zero. So, okay. On the other side, we're saying $50,000 is the cost divided by 8 years, which is going to be $62.50 a year. Now, they may, if it's 13 years, and for tax purposes, they may not be able to get away with this because the IRS will say, okay, what is that? They have tables that sort of break out assets. And so companies trying to speed up the depreciation in order to lower their tax expense may not be able to get away with it. But for financial accounting purposes, again, it may be perfectly acceptable. And so there are differences between book and tax accounting. And we know that for those of you who go on to take corporate tax, we'll see how we have differences and we have to do a reconciliation from GAAP accounting in order to get to tax. Okay, so that's essentially what's going on. And these are the journal entries, right? So amortization expense in both cases, they're income statement items, expenses, debit balance, and we're reducing the value of the asset itself, assuming we're not using a contra asset called accumulated amortization. And that is sometimes used, and so that is out there. So, but nonetheless, same income statement effect and same effect on the net book value is going to be the case, whether we credit the asset directly over time or we capture it in a contra account. Okay. All right. So let's talk about software costs, software development. This brings us back to the notion of R&D and how we account for them. What is different, though, is the fact that here the reporting company is allowed to take either the greater of whatever the percentage of revenue that's expected over the life of this particular intangible asset, which is software, right? And it does not have an infinite life. As I think we know, software becomes obsolete fairly quickly. We do that with the straight line method. We're allowed to take either one. So, and that's the amortization expense that we're allowed to take based upon one of those two methods. But how do we get to this depreciable base? Well, first of all, we have to understand the timeline here. We need to sort of cut things off when the asset is commercially ready to be ready to go into to practice. In other words, the technological feasibility is the term of art used here. And it may not be it may not be ready to hit the market, but the R&D is done. We have this product; it's going to work. We've tested it, done all the beta testing and all this good stuff, and so it's going to work. And then all the costs up to that are R&D expenses, and so we write those off. And so in this case, June 30th is the date at which we have reached technological feasibility. And so up to that point, we had 1.2 million of expenses. And after that, until this thing did come to the market, we have 800,000, which is going to be capitalized. Okay, so it was available for sale just a few months after that. So here's what we've got going. We had 3 million sales. We were expecting up until 2025, which is presumably the end of the useful life of this intangible asset that is the development cost. And so estimated sales over 4 years, I'm sorry, is $10 million. So 2021, what are we doing? Well, we're going to expense the 1.2 million because those are R&D expenses. And again, we do not capitalize R&D expenses. We got into this a bit I think it was in chapter 10, where it's been controversial for a long time, but FASB does not allow R&D expenses to be capitalized because again, some products never make the market. So, if that's the case, why would you call something an asset when it does not have future service value? So that would sort of defeat the purpose. And so we expense those. But once this product is available and ready to go, it doesn't mean we're going to have knockout sales, but it does mean that we're going to capitalize those costs. And so we're going to expense the 1.2 million. We're going to capitalize or put on the books as an asset 800,000 that we're going to then amortize over time. And so here's what's going on. And remember, we have these two different methods we can use, either the greater percentage of revenue or the straight line method. So this is not terribly complicated math. I don't think it's going to bug you much. But remember, so 3 million in sales in that first year, right here, 2022, because that's when the first it became available. So divided by the total expected sales over that period of 10 million, so it's going to be 30%. Times that 800,000, which we're capitalizing, is going to give us 240,000 under this method, the percentage of revenue. If we simply did straight line, we're saying it's 4-year life, so 1/4 is 25%. 25% of 800,000 is 200,000. And we get to choose the greater of 240 or 200. And we're probably going to take 240, and we're going to choose that method because it produces the greater amount of amortization expense. So, okay. So that's how we would do that. And software is one of these intangibles. The value of software does go down over time. This is why companies are continually coming up with new software all the time. It's why they're in existence. If we use the same operating systems and the same programs that we used 30 years ago, what would these companies be doing? They wouldn't have any products to sell. So they've got to continually upgrade these, and that's this replacement cycle is a key part of what software companies have to do. And so, and that's good because it sort of forces innovation, and so software is better and better all the time. Okay. All right, and there are some assets, I think I alluded to this a second ago, that do not have a definite useful life. And so we say they're indefinite, and we don't amortize them because we don't, first of all, we don't know what time period to amortize these over. And so we don't amortize them. And so we just keep them on the books at the acquisition cost. And in the case of goodwill, remember, goodwill is a premium amount paid in excess of the fair market value of assets acquired. And it's really a sort of catch-all intangible asset that captures things. And I would imagine that the acquired company would break it down into its component parts, like what is the value of management, what is the value of the market share, what's the value of the reputation, what's the value of their their productive assets, or they relative to the competition. So goodwill is an intangible asset, and it's not a small number. And I wish I had remembered to include, there's a chart I've got that shows the amount of goodwill on the balance sheets of companies, and it is a staggering amount of money. It's a big amount because goodwill can only be acquired. You cannot internally generate goodwill. So because we don't know what the useful life is, we don't amortize it. I think at one time we did. I think it was a 15-year amortization, but don't quote me on that. But it seems like in the past we did amortize goodwill. Trademarks, the trademark can last forever. I mean, the Coca-Cola trademark, it's interesting. My son was looking just the other day at old Coke bottles because he wanted to buy there were these replica Coke bottles he wanted to buy for a relative for Christmas. And I just happened to notice that the logo is pretty much the same as it was in the 1890s. And so you can't obviously use that logo on anything else, but without the consent of Coca-Cola, or else you're encroaching on their trademark. But it goes on for a very long time. The same with trade names. The trade name Coca-Cola. There has been some. I think a linguist said one time that it's one of the most recognizable names on planet Earth, the name Coca-Cola. So, which is kind of funny, but you get the idea. These things have an indefinite life, and so they're not marked down. However, they can be marked. I'm sorry, they're not depreciated or they're amortized over time. They can be marked down, however, due to impairment. And that's the thing that we should talk about. If for whatever reason it turns out that these assets do not have the represented value, then it's incumbent upon management to mark those assets down by taking what's called an impairment loss. And so, and the tests for impairment differ between international and GAAP standards. And so we're not going to get into that here, but it really has to do with what is the expected cash flow that can be directly attributed to that asset. So that's a test for that. And it is possible to mark those assets down over time. And I think it's probably safe to say that sometimes goodwill does get marked down, and companies may do it during periods in which expectations for earnings are not quite as robust, i.e., a recession. There is some evidence that companies sometimes don't always mind a little short recession because it allows them to take all the junk off their books and write them off and blame the economy or blame the president or whatever they want to do. And so, there is that theory that companies will use that opportunity or they clean up their books and whatnot. So one of those cleanups would be reducing the value of intangibles by taking an impairment loss. So, okay. And they can blame it on whoever they want to blame it, but that's one opportunity. It's a theory. It's not, I wouldn't, hang my hat on that, but there is that belief that companies do sometimes not mind the opportunity to be able to clean up their books. So, okay, or clean up the balance sheet. All right, so one final bit here before we sort of wrap this up. We talk about the valuation of intangibles again, just like other long-term assets. We're not allowed to revalue them, particularly on the upside. Obviously, we can impair them and it'll come down. So it's not quite, the revaluation is downward if anything, but we're not allowed to say, oh, now this patent's worth more than what it was before. We're not allowed to do that. In fact, it may change hands at some greater price, and the new acquirer may have their own valuation of that, but the present owner of that patent or copyright or whatever cannot mark that up. In the international standards, we'll put it on the books at cost minus any accumulated amortization, if there is, or the fair value, if the fair value can be determined, but we can't do anything with goodwill. We can't revalue that. But again, we can still make an impairment in the international standards. Okay. All right. So a quick quiz here. Which of the following statements is true regarding the valuation of intangible assets? Okay, so which is true? U.S. GAAP allows a company to value an intangible asset at fair value. Stop right there. No. IFRS prohibits the revaluation of an intangible. No, that's not right. C, IFRS allows a company to value an intangible at cost plus accumulated amortization. That makes no sense. So it's got to be D, U.S. GAAP prohibits the revaluation of any intangible asset. So sometimes these answers are completely obviously ludicrous. And so obviously, why would you add accumulated amortization? That makes zero sense. So, okay. All right. So this brings us to the final bit, and we're going to sort of wrap this up. And that is changes in estimates. And I want to talk about what we're talking about here with regard to changes in estimates. Remember, we're not talking about earnings estimates. Let's not confuse ourselves by, sometimes, a lot of times companies will say, hey, we told you we were going to earn 24 cents a share next quarter. We're going to miss that. We're not talking about earnings estimates. We're talking about estimates of things like residual values. We're talking about long-term assets, things like residual values, estimated useful life. And when those things are revalued, because facts have changed, and when the facts change, we have to change our accounting. So, there's no sin in that. And in fact, it's accurate accounting to do so. But what we do, we don't go back and restate financial statements. We don't go back and recreate history and say, oh, well, you know what? We thought it was going to be a 5-year useful life. Now it's only a 4-year useful life. So we're going to go back and go back in time and jump in a time machine and recreate everything. And we're going to reissue financial statements. No, we don't do that. I'm not saying companies never have to restate financials, but when they do, it's usually something really, really big. And oftentimes they're sort of prompted maybe by the government or some government somewhere, and it's really considered not a very good thing. The financial community does not look kindly on companies restating financial statements. So, but that's not what we're talking about. We're not talking about some major error or some major misapplication of accounting theory. We're simply saying that the facts have changed since the acquisition of this asset. So now we're going to change things for this particular accounting period and everything subsequent to that. Okay. And so we're going to change, and there should be a disclosure note saying what the effect is going to be on net income, and any kind of related per share figure. And, all we're simply saying is net income per share is, AKA earnings per share. And if it's a material effect, we're going to report that. So, okay. All right. So here's the example. So January 1st, 2019, Hogan Manufacturing purchased a machine for $250,000. Okay. We've seen this scenario before. 5-year service life, residual 40. Okay. We've seen these facts before. And, but 2 years in, the company revised its estimates by saying, okay, it's not a 5-year, it's going to be 8 years. So we're going to add 3 more years to the estimated useful life. Okay. And we're also, and because we're doing that, we're also going to bring down the residual value from 40,000 to 22,000, because we think in 3 more years it's going to be worth a lot less because it's been used and banged up over time. And so here's the accounting. So their fiscal years end is 12/31. So we're going to take the first 2 years depreciation before we restate as we go forward here. And so remember, straight line depreciation for this particular asset, which is cost minus residual, is 210 divided by 5 is going to be 42,000 a year. And we've taken 2 years of that. So we have 84,000 in accumulated depreciation. Cost was, where is it? 250 minus the accumulated depreciation. It brings us our book value down to 166. We're not changing that. We're going to keep that, but what we're going to do is we're going to revise the change the residual value down to 122. So now it makes the new depreciable base 144, and instead of 3 more years to depreciate, we have 6 more years. 144 divided by 6 is 24,000. So that becomes the annual depreciation expense going forward, just based upon that change in estimate. And so it's not terribly unusual that companies will do that. So they'll do it. And in fact, they may want to do it because it does reduce or does pump up net income, all else remaining equal. You're taking less depreciation expense, and so that's kind of good. So the journal entry is very simply accumulated depreciation expense debit. That's an income statement debit, and accumulated depreciation 24,000 is the entry to the contra asset. Okay, and then on January 1st, 2021, Esquire Corp purchased equipment for a cost of $165. The equipment was expected to have a service life of 10 years and a $15,000 residual. The straight line method was used at the beginning of 2023, which is, what is that, 2 years in. We've changed the residual from 15,000 to 0. Okay, and that may be, and so that may be correct, right? Maybe 0 may make sense. Some companies have put 0 salvage even going into it. So 165 divided 15. I'm sorry, 165 minus 15 is 150. So you're taking 15,000 a year, 150,000 divided by 10. That's 15,000 per year. Okay, and so that brings the book value down to 135. 165 minus 30,000 is 135. And now we're simply going to take the same for another 8 years. And so what is 135 divided by 8 here? And I don't know the math offhand, but let's take a look here. And so we're going to get 16,875 in depreciation expense every year that we go forward. So, okay. And so, until we get it down to the residual value. And then again, as with all assets that are depreciable, we depreciate them down to the residual, and then we stop from there. So, okay. Then when they leave the books, that residual becomes the book value that we compare against any acquisition price, if any, in order to record any kind of gain or loss. Okay. And so here's an example of the notes here when something has changed. And this is Verizon's. I don't know. I guess it was 2016. And they're saying that we determine the average useful lives of certain leasehold improvements. And that's things like, things like that you would do to property leasing, like sprinkler systems and guard handrails. A lot of leasehold improvements were put in for disability purposes. And so, but it isn't just that. It's things like, widening doorways so you can get forklifts through and stuff like that. So, and we're saying now they're going to expand that from 5 to 7 years. So it's going to result in a decrease in depreciation expense of $200 million in 2016. And we said they're necessary for these particular reasons. So you can read that, but that's been the change in that particular thing. And it looks like also that some of these have been upgraded and whatnot. So actually, putting new money onto those, new value onto those assets. This is something we really didn't talk about much, but sometimes, there are parts that may wear out. Maybe it's a delivery vehicle, and you're putting a new engine in. Well, that new engine becomes part of the value of the equipment once again. So we would have to do that. Also, things like when it comes to leasehold improvements, I think this is an interesting one. It's something people don't think about. Things like energy efficient windows, right? That don't belong to the lessor. I'm sorry, the lessee, the company that's leasing it, but they're benefiting from it, and so they're going to depreciate that over time. And so that would be another example. So things like doing things structurally to doors and to making ramps and energy efficient windows, upgrading things like HVAC and all those kind of things are when it is a property owned by someone else leasing it to them. And sometimes they'll do it because they need it to be done. And sometimes these leases are very long-term nature, and so it makes sense to do that. So okay, but this is an example of a note you might see. And again, I've said this many times before, that looking at the notes to financial statements gives you lots of information as to what's going on. And so particularly things like accounting methods used and changes in estimates and just things in general that users would want to know about. And so And some of these are definitely mandated by GAP standards as to what people should want to know about. So this would be one of those things that is necessary and useful. Okay. All right. So hopefully this is helpful to everyone. And we're going to pick this up on Tuesday. And we're going to jump off here by talking about any kind of changes in methods. And a lot of what we do in accounting is dealing with changes in methods. And again, as I've said before, a lot of intermediate accounting is dealing with things like methods, techniques, things that, in different methods that sometimes are applied. And these are things that come up in the lives of accountants all the time. And so this is one of these courses that is sort of the gateway to the profession. So, okay. So if you have questions about anything, feel free to reach out to me. I'm in, throughout most of the week. And so I'm more than glad to get with you. And so I will see you all on Tuesday.